Good morning, my name is Przemysław Kwiecień, I'm Chief Economist of XTB, and it's my pleasure to have you on our weekly trading webinar. So today, the story of the webinar is, can we predict a future crash? I think that this is a question that at least quietly many investors ask themselves, because looking at the environment where we see especially inflation soaring lately, and many issues with global supply chains affecting the economic outlook, and at the same time when we see major global indices going higher and higher and higher, and I think many people ask themselves, does it really make sense, and can we possibly point at any reversal that could end this bull market? So this will be the story for us today, but let's start from the top news on Monday morning. I think the biggest news is that the markets have fairly benign reaction to U.S. inflation, which was the story of the past week, where as you may know, U.S. inflation soared to 6.2% year over year, which is the highest in more than 30 years. So really inflation is there, and yes, you had slightly, as you can see here, you had slightly lower bond prices, which means higher market interest rates, but at the same time you had gold price soaring. Yeah, you could think, okay, maybe gold is kind of inflation hedge, but then again you also had stronger dollar, but at the same time you had virtually no reaction on indices. Yes, they were slightly lower on Wednesday, but this was just erased on Friday, and you could ask yourself, well, what's next? If you get such a bad news and markets still do not react, so how could this end? So this is one of the reasons why we actually ask ourselves this question today. Otherwise, we didn't have many really groundbreaking news. We had the Chinese data today in the morning for October, and they were slightly better than in September, with output and sales slightly higher, but still, for China, output rise 3.5% year over year. It's still pretty benign, it's still pretty low. So yeah, definitely China is a place to watch with this real estate crisis lingering. Yes, there was no shocking failure so far, at least, but definitely it affects the economy. So definitely worth watching. This week, we'll still return to this, but this week we have a lot of FOMC speeches. So this is something, again, you might be paying a lot of attention to. All right. So before we move on to the story of the week, let us go quickly through the inflation figure and the markets. As I said, inflation is rising very quickly. As you can see here, this is the level that's highest already from the beginning of the 90s. We had a peak here, and then beginning of the 80s actually. But if you look at the dynamics, it wasn't as sharp back into the beginning of 70s, when inflation was actually soaring from also a long period of low levels, and I think many people ignored this inflation until it was too late. If you look at the structure, you can see, yes, the motor fuel is the biggest contributor to inflation increase, but then you have a lot of other things, which shows that actually inflation is gathering pace. Yes, annual inflation, you have still a big contribution from fuels and car prices, but even if you strip out those two, you would see clearly increasing inflation in other categories. So I think definitely this inflation is broadening, and on one hand you have some positive factors like declining coal and iron ore prices on global markets. Baltic dry index is slumping, so these are taken as positives, but then again I think people are adjusting to their expectations and expect more and more persistent inflation out there. So definitely I would say this is a risk, but the markets, because of obviously of the Fed policies, remain quite ignorant. Especially, I think if you look at the indices, they, they really behave as if nothing happens. Last month, at the beginning of October, we argued purely on the technical basis that we could see a strong rally here on the Nasdaq, and this is just what happened. As you can recall, we discussed this second lower bottom, which occurred here a couple of times, and on each occasion it suggested a renewal of the rally, and this is what happened again at the beginning of October, and we discussed it here. And yes, there was a very strong wave B, but last week with this inflation we only got this one red candle. Already on Thursday equities were gaining, and on Friday very strong day for mega caps in the US. So yes, I would say a lot of self-confidence on the markets, but a possibility of this C corrective wave is there. I'm only talking about the short term, because long term we already know we are in a kind of a bubble, and anything can happen. In the bubble you can go very sharply in a short period of time and then crash. So even though we are very high, doesn't mean we cannot go higher. But in the short run, looking at these patterns that we had over the last year, yeah, I would expect that perhaps this wave C is something that looks looks plausible. This wave B was very extended, but we are close to this upper limit of this wedge, and there were already some signs of fatigue here. So yes, this rebound on Friday complicates this picture a little bit, but we'll see. Maybe we can go even higher in the short term, and then we have this wave C. This would be my bottom scenario. On the DAX, not a huge reaction to the US data, which is, I guess, understandable, but we are also seeing some fatigue of this trend, just like we saw here. So it's quite possible that we have some period of weakness ahead. As I said, US dollar gained, which is in line with what we were discussing on many occasions, that we have a downward trend here on the euro dollar main currency pair. What's important here is that this consolidation around 115, 116 here was kind of last line of defense, because we had this double bottom here and really no other strong support in sight. Yeah, you could say maybe yes, these levels 112, it's some kind of support that can be traced here, but really right now, once we broke out of this consolidation, really there is a possibility that we can go lower, and yes, in the short run we are on this lower limit or close to it, so there is a possibility of some small bounce, but yeah, the trend looks very strong. Just as we are discussing the euro dollar, we can take a look at the pound. Where do I have it? We can take a look at the pound. Well, as you know, markets expected interest rate hike, and they didn't get it, and yeah, and therefore, even though the pound is not as weak as euro, there is still this, I would say, downward trend. We don't have such a strong trend as we had on the euro dollar. We have more of a prolonged, this racked correction. Yes, we are a bit oversold here, so I think a bounce, short-term bounce is possible, but so far we have lower highs and lower lows, so this suggests also a downward direction for this currency pair. And finally, last but not least, precious metal prices really had their week or even 2 weeks, despite the data, strong NFP and then high inflation, strong dollar, higher yields, that all of this would suggest possibly downward movement on the gold market. Why we spiked higher is, I guess, a reflection that the markets do not believe the Fed could actually do anything. So So yes, I think in longer term, as I said many times, gold and silver and other precious metals, they are attractive hedge against inflation. We saw this in the 70s. However, should the Fed change the direction, of course, there is always a risk of something like this happening. So you need to bear that in mind, but perhaps the entry point is no longer as nice as it was here. But yes, I think it doesn't necessarily need to be the end of these gains, especially as you can see here, we might be around here comparing these moves. Okay, let's move to the story of the week and yeah, ask ourselves, can we possibly have an indicator where that would tell us, look, this is the end of the bull market, you need to sell, or this is the end of the bear market, you need to buy. Well, one of the reasons, I mean the main reasons I already told them, but yeah, one of the reasons that the chart that I saw on the internet showing us Schiller P, which is cycle adjusted price to earnings ratio for S&P 500 for many years. It spans I think 150 years already, but it's not shown in a nominal axis, but it's in a centile axis where it shows which centile of historical occurrence you are in. So we are around 100%, which occurred previously only 2 times in 1929 and at the top of the dot-com bubble 20 years ago, more 21 years ago. So yes, on both occasions, as you know, it predicted a crash. The problem is that it occurred only 2 times in 120 years over here. So yes, so definitely a nice indicator and something that could attract our attention. However, I think that that's not enough, and therefore let's look at other indicators. Here we have we see indicator which is also based on PE, but also on some trend deviations. And again, we are actually much higher than here. So yes, looking at these indicators, you could always have an impression, well, yes, the market should crash because we are higher than ever before. But the problem is that if you are an investor using this kind of indicator in the 90s, you'd be already wanting to sell at around, I think, 97, 98. And as you may know, in 97, from the beginning of 97 to the peak in 2000, the market doubled. So even though it crashed later on, it only crashed to this point of the beginning of 97. So yes, so I think there's the problem with this indicator, that yes, on many occasions it actually pointed overvalued, undervalued, but actually, especially on the bear markets, it actually were much more precise, because it was around minus 50%, but it was also many years ago. And last time around, this huge GFC crisis, it was already just minus 10, and then the COVID. It's even hard to call a crash. If you look here, it was already very positive. So not very useful. I mean, it looks nice, but it's not very useful in predicting a turnaround, at least last, I don't know, 30 years. So let's look at the other indicators. And I played a bit with the data on earnings, expected earnings, and sales. This is the indicator that combines all those 3, and it shows that yes, we are at the highest point since around 2001, so in 20 years. The problem is, as you can see here, that it's already quite flat here, and the market keeps rallying, and also that you don't have this sinusoidal behavior in the meantime. Yes, you had at the bottom of this dot-com bear market, you had less than -1. At the bottom of 2009 bear market, you had more than -4. One of the reasons is that expected earnings, where you often hear, look, you need to take into the account expected P for stocks or indices because they show the future. Well, it's not true, because analysts on Wall Street, they adjust their expectations on earnings to market situation. As fun as it looks, it's actually the truth, which you can see on this chart. You could see here that the market expectations of future earnings are completely unrealistic. The earnings already rebounded very strongly past the COVID, this COVID slump, and markets expect them to rise by around 15-20% year over year for the next 3 years, which is unrealistic, of course, because that will require some unrelenting economic boom, which obviously is impossible with all these issues that we see in front of us. So why do markets expect stock earnings to rise like this? Well, they need to match their models with the reality of high stock valuations. So let's say analyst has some target for Apple stock, which is, I don't know, let's say 100, and they see, okay, market is already at 150. I need to adjust my model because I look stupid. So, but if I want to adjust my model, I need to put higher earnings path, because otherwise it doesn't make sense. So therefore, expected earnings is really not a very valuable indicator. If I strip it out, it already looks better. You have, except for this really major slump, you have some sinusoidal behavior here, and we are already higher than in 2000, only looking at sales and historical earnings. The problem is that also, here, for instance, before this crash, we weren't really warned by this indicator. So, and of course, the history is only 25-26 years. So it's not, we cannot verify this on a long term. So let's take a look at other indicators. One of the indicators that I found on the internet, again, is something interesting, which shows deviation of earnings from the trend. As you can see, yes, we have a third situation where this deviation is around 40%, and yes, both times before it actually worked. Well, okay, fair enough. Yes, there is a period of more than half year where it's already flashing red, and markets still keeps rising. But yeah, let's give it a chance. Looking at other indicators, first of all, we have this indicator where we look at the rally from the 2-year low. Before, a rally between 65% and 85% always meant the top. Now we are above 100. Economic expectations or economic sentiment. Here I look at consumer sentiment in the US and ISM manufacturing, and again, very high levels of 1.4 on this indicator usually meant the top. This time we didn't really get there because consumer confidence already deteriorated, and of course we didn't have a top. Margin change. A margin is important because if investors become too optimistic on the market, they incur more debt to buy more stocks, and therefore they blow the bubble, which eventually bursts. And I mentioned this on one of the webinars in the spring, that before 60% year-over-year change in margin always meant the top, at least a local top. This time, however, it didn't work. We already were past this level, and the margin still rises, but not as quickly. And of course, we didn't have the top. At least we haven't seen this yet. Other indicators, options market, it looks a bit like at the end of the stock market era, but of course there is no clear indication of which point is this reversal point. Also the housing market, yes, it's also the hottest ever. It's similar to the beginning of the 70s, but again, it's just only a suggestive, I would say, suggestive indicator rather than something really strong. Some people think that the bull markets end in euphoria, and this is also a bit questionable. If you look at this chart, it shows how the S&P behaved 100 days before the ultimate peak and 100 days after this peak before a crash occurred. So as you can see, I took only the most severe cases: 2019, 29, 1973, 1987, dot-com bubble, and 2007. I didn't take this COVID crash because it was a bit different. So as you can see, yes, there were instances where actually, yes, markets really rallied very hard. There's huge euphoria. before 1999 and 1987, but there were also instances where the markets were already quite calm, and that was actually, as fine as it sounds, at the top of the dot-com bubble. As you can see, even before this ultimate peak or even afterwards, for many days the market was really calm and only crashed later on. So it's not always where the absolute top needs to be preceded by some really untamed euphoria. So I think that the bottom line is that yes, you have a lot of these indicators which can tell you, look, the market is overvalued, and especially if you're a long-term investor, you need to bear that in mind, that maybe investing too much at this stage is risky, and maybe if you are already invested, it makes sense to take some portion of your investments out of this long-term portfolio. I think this is the way you want to look at this, and you can combine this approach with fully passive investing in some stocks or ETFs to have part of your portfolio being increased regardless of market condition, and this part of your portfolio being a bit managed looking at this indicator. But I wouldn't rely on single indicator or even a mix of indicators telling you yes, this is certainly the top, because even if it worked in the history, it's not physics, it's not it's not something that always repeats exactly in the same manner. Okay, so bearing that in mind, let's move on to what happens this week. And this week we have some data in the US on Tuesday on retail sales and industrial output, but more than anything, we have at least 14 FOMC speeches, which we will report for you in the news section of Xstation mobile platforms. So please make sure to track our news flow, so you can stay up to date with the market. And yeah, as I said, all these reactions with stocks still being very euphoric, with gold rallying despite strong dollar, it happens because market expects the Fed to ignore rising inflation risks. So should this continue, these trends may do very well. But should anything change, obviously it may have decisive impact on the market. This is, I think, something that investors want to track in the first place. So yes, we have a lot of these speeches, and they will provide opportunity for us to know how the Fed interprets the latest data, because last time around when they met, they said, look, okay, we start tapering, but we do not think yet about increasing interest rates. But since then, we had very strong labor market data, and obviously we had this really striking inflation report, and already we heard, like from this Kashkari speech, some suggestions that yes, we will ignore it again, and that's the most likely outcome. But maybe some other guys will have something different to say. So definitely these speeches are worth watching. All right, ladies and gentlemen, thank you for your attention. We see each other next Monday. Have a great week.